My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to make you a little bit of money. My job is not just to educate, but also to entertain you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. This market has the memory of a mayfly. That creates a ton of opportunities. So today, where the Dow gained 317 points, S&P advanced 0.39%, NASDAQ climbed 0.19%, after, by the way, looking truly awful in the morning. I want to help you find them. Time and again, I've seen growth stocks just get pummeled on some little bitty bit of bad news, some downgrades, some niggling nonsense about a quarter with less hair on it than I have, and the punishment doesn't fit the crime, if there's even a crime at all. This morning, for instance, Disney reported it was a terrific quarter. Theme parks much better than expected. Movies, fantastic. TV and sports, a real positive. But there was this one line involving Disney's streaming property. When it raised prices, there was some churn and subscribers dropped by 1%. Oh, no, the genius traders said to themselves. Netflix had no churn when it raised prices, so let's bury this stock. Sell. These wise men and women sold Disney down into oblivion. Not thinking about two things. One, Netflix is a beast, the best without compare. And two, Netflix doesn't have parks or cruise ships or even a fraction of Disney's intellectual property. I bet that in a few weeks, people will forget why they sold Disney stock down. And the stock, it will be higher. Same thing with Uber. You see, Uber won the war of pick up and deliver. The numbers reported this morning were extraordinary. But the experts found a line or two they didn't like. Next thing you know, they kick it to the curb, and you get an opportunity to buy some at a discount. I am confident about this one after interviewing CEO Derek Khosrowshahi this very morning on Squawk on the Street. I'll give you a little more on Uber's prospects later, but I think this is a good one. Now, we see this pattern constantly. Tesla will sell off over something. I don't know, maybe it's German numbers, it's California numbers, it's China business. I heard today that people have stopped buying Teslas because Musk turned out to be a Trumpist. I say, so what? He's going to solve the self-driving conundrum. Of course, Tesla always has some acolyte-loving person who comes on our air and blesses it and says it's worth $1,000 and it's off to the races again. And that will happen. That will happen. Now, here's an easy one. Spotify. This is a subscription business like Netflix that keeps on growing and growing and growing. It's the ultimate beat and raise stock. But there's always someone down there giving them the business. I saw it today when an outfit said Spotify's run too far and it's peaking. To which I say, based on what? I didn't see a thing in the piece that was convincing, but the stock still got knocked down in the morning. It gave you a great entry point before it rallied and ended the day in positive territory. Now, we saw this with Abbott Labs, ABT, not that long ago, when it lost a lawsuit involving a special infant formula that some aggrieved parents thought harmed their baby. The formula was made by Abbott because women sometimes just can't produce enough milk. Abbott only made $9 million a year on it. I think that they actually, on this formula, I think they do it at the behest of the government, or they're just literally out of their hearts, but it doesn't matter. They lost a $500 million lawsuit. $500 million. And now I told you to dismiss it, not worried about it. Sure enough, what happened? Abbott stock is now up more than 30 points from that event. I've seen this happen endlessly with American Express, AXP too. It'll creep up, and the fact that the millennials and the Gen whatevers love it, and then it reports on a sleepy Friday. It always reports on Friday. And everyone runs from it like it's got the bubonic plague. But 2 weeks later, American Express is up from where it was before the quarter, and people have forgotten why they sold it. Same deal with Marriott, growth hotelier. It heads down after reports, then soars when people realize it is the best hotel chain out there. I even see this with Costco and Walmart, the two best retailers in America. When Costco reports, people tend to be repelled by the quarter. It could lose 100 points, only to start the trek higher again, as there was no reason to sell the stock in the first place. Someone will always find fault with Walmart or say it's run too much, and they'll sell it down. A week later, another analyst will remind us of the buying opportunity that it is, and we'll jump at the chance they both hit all-time highs today. Finally, cybersecurity. Just over 6 months ago, a glitch caused by CrowdStrike seemed to stall the whole world. Then the CEO, George Kurtz, truly an indefatigable gent, visits 130 companies in 100 days for a genuine apology tour, and all's forgotten and forgiven. In response, the stock quickly takes out its old high. Can you believe this? Cloudflare and Palo Alto Networks, they're comeback kids, too. Every time. Oh, and let's not forget the ontologists at Palantir. Those guys can do no wrong, especially in the eyes of their buddy investors. Now, if you buy these every time they get hit, you'll do well, because they shouldn't be hit in the first place. So you're probably saying, can it really be that easy? I mean, why aren't I a millionaire? Well, I'll tell you why. because there are landmines, real landmines in the yellow brick road. Times when the dips are merely the beginning. So I'm going to spell those out for you, too. First, you have to ask, is it dependent upon China in any way, shape, or form? That's been the kiss of death for a really good casino company, Wynn Resorts, and for Estee Lauder, the mess of a cosmetics company. The one sharp as attack people, actually, Danaher, who've lost their way and don't even know it, have been bashed by China. Oh, and let's not forget how well Merck could be doing if the Chinese government didn't slow play the rollout of the Gardasil vaccine for no particular reason other than, forget it, Jake, it's China. And as China... I mean, honestly, what the heck happened there? We're worried about Apple now, which has to be one of the largest employers in the entire People's Republic. The Chinese Communist Party is now going after Apple for the service stream almost as hard as the U.S. Justice Department did under Biden. Oh, and anything chemicals. Those need Chinese orders desperately. Second, can the GOP just one drug stop the craving for the product? Hershey bars, donuts, Camus, all the Johnny Walkers, Jack Daniels, Casamigos, Oreos, Twinkies, Lay's potato chips, Frosted Flakes, Fruit Loops. If it tastes good, the stocks of these creators are out. Third, department stores of any kind. Doesn't matter. Kohl's, oh boy, try saving that one. Macy's, no thank you, although I sure wish it won't so. Let's expand it. Does it sell in department stores? Capri, PVH, Tapestry, sold to you. Sell. Nothing's foolproof. I wanted to put a video on the Always Right story, but what if Amazon says tomorrow that it's developed its own chip to lessen its dependence on NVIDIA after the DeepSeek scare? I thought Ferrari might work, but that thing's gotten way too high. In the end, it is a car company. Vertiv fit the bill because of its data center affiliation, but that's become a battleground, too. We don't need no stinking battleground. Bottom line, always remember that there are indeed Teflon stocks in any market. The key, don't buy them unless and until they get knocked down. And then remember, they'll get up again. You're never going to keep them down. I need to go to Chuck in North Carolina. Chuck!
Booyah, Jim.
Booyah, Chuck.
Thanks for taking my call. With the recent market volatility, I'm looking to add a stock with a sustainable dividend. And if not this one, maybe you could recommend another, but I'd like to have your opinion on adding CVX Chevron to my portfolio.
Yeah, boy, that's a great one. I'll tell you why. Mike Wirth is just the CEO. He's committed to that dividend like no other. They've got giant cash flow. It is not a problem. It's one of the safest dividends I know. I bless that investment. Sharon in Minnesota. Sharon.
Hey, Jim. I hope your family's doing well.
Absolutely good.
That's great. The question that I have is about Salesforce. It's going to report soon. It's close to its high, and I'm wondering whether it's a good time to buy now or to wait until after.
I actually think it's okay. There was a really terrific piece out by Morgan Stanley yesterday about what the clients are doing and how great it's been, Agentforce has been for them. It's such a winner that I smiled. I said, oh, my God, Mark Benioff is going to do so well. I think you stay in the stock, and if it gets hit, I would buy more. That's how much I believe in their Agentforce. It's terrific, and thank you for the call. How about Lonzy in my home state of New Jersey? Lonzy.
Hey, how you doing, Mr. Cramer? First-time caller. Been following you since my financial class back in '97.
Oh my God, I've really been around. Wow. Well, let's go to work.
Hey, man. Just wanted to know what's your thoughts on Marriott, and are they the top dog when it comes to lodging and hotels?
They are, and I don't even mind that the stock is 3 points off its high. You buy some, and then you let it go down. It is at 30 times earnings. That is a high multiple for Marriott, but the travel thesis is so strong. You don't know when you're going to get in, but you buy some. You don't buy all of it right now. You buy some. That's the prudent way to do it. All right, listen, people, nothing's foolproof, but some stocks are more Teflon than others. The key is to buy them when they're down because they won't stay down for long. On Mad Money tonight, Alphabet is down 7% after crossing the tape last night. I'm eyeing the tech's giant CapEx commitment and how it could affect the stock moving forward. Then, what's the road ahead for Uber? I'm getting a read on the ride-sharing company after the stock slid on the report. And later, I'm checking in with the CEO of Columbia Sportswear to hear if today's post-earnings dip could be a chance to buy in a turnaround story. So stay with Cramer. Last night, Alphabet, the parent company of Google, reported a seemingly disappointing quarter. And the stock just got slammed today, down 7%. That's the headline, but when you dig down to the details, what really freaked people out is that they're planning to shell out $75 billion in capital expenditures this year. Yep, they're being punished for investing heavily in growth, which is a big change from last year. Of course, that's not the only reason the stock got hit. First, keep in mind that Alphabet stock had run up nearly 25% from the end of September through yesterday's close. It was really charmed. It was making it the third best performer in the Mag 7. So the expectations were certainly not low. But then Alphabet reported the quarter was mixed, to say the least, with slightly weaker than expected revenue and a market deceleration in growth, even as they also delivered a 2-cent earnings beat thanks to better cost control. No one really cared about that, though. Their core advertising business is still doing great. Both search and YouTube, wow, YouTube was great, outperformed expectations. The top line and shortfall from its Google subscriptions, Google Cloud, and the company's catch-all other bet segment, the Google Cloud weakness was particularly surprising. In the previous quarter, this business put up great numbers, but its growth rate slowed substantially in the fourth quarter. Now, that was a key pillar of the bull thesis, and it's been kicked over. It needs to return to toward growth now to make up for all the data spend that's been going on. In the earnings statement, CEO Sundar Pichai boasted about all the things that are going right, search, AI, YouTube. Then they went on to drop that $75 billion bomb. While this company doesn't give much in the way of formal guidance, they mentioned that they expect revenue headwinds in the current quarter, thanks to currency fluctuations, as well as some tough comparisons for Google services and uneven revenue growth for Google Cloud. But it really seems like it was the $75 billion in capital expenditures that truly freaked people out. Looking at the action today, Wall Street sure didn't like that number, did it? Yep, Alphabet got hit because it's investing too heavily in growth. And that represents a huge change from what we've been seeing very lately. Now, that $75 billion, it's CapEx. It's a commitment. It represents a big step up, and this was what was really important. From the $52.5 billion they spent last year, a lot of people were hoping that was going to be the ceiling, and the $30-odd billion that they spent in 2022 and 2023. Now, much of that money is going toward AI infrastructure like GPUs from NVIDIA and custom accelerators from Broadcom, hence why those two stocks rallied big today. But we've been seeing major CapEx commitments from many of the other tech titans in recent weeks, and to date, the market lapped it up. Microsoft kicked things off the first few days of January by announcing $80 billion of investment in AI data centers this fiscal year. Stock gained more than 1% that day. Microsoft was up nicely for the year until the company gave soft revenue guidance last week. In late January, Meta platform CEO Mark Zuckerberg announced that his company was planning for $60 to $65 billion in capital expenditures this year, mostly on AI infrastructure, Meta AI. Pretty good. And then the stock jumped at 2% that day. It's still up 20% for the year. It's terrific. Then there's the big one. The Stargate AI infrastructure venture that Oracle's Larry Ellison, SoftBank's Maya-san son, and OpenAI Sam Altman rolled out at the White House on January 21st. That was Trump's first full day in office. They're spending $100 billion up front and could go up to $500 billion over the next 4 years. Now, some have questioned whether these companies even have that kind of money, but hey, who didn't care? I mean, Wall Street. Oracle stock gained 14.4% over the next 2 days. And while it's since given back much of that move, clearly AI spending was not seen as a problem 2 weeks ago. So you can imagine you've got this one company spending far more than we thought. And then what happens? Its stock goes up. Now, something big changed in recent weeks, though, and that was the arrival of DeepSeek. That's a Chinese generative AI tool that seems to perform nearly as well as any of the leading-edge, expensive U.S. AI systems, and was allegedly developed with far less hardware, meaning a heck of a lot less money. DeepSeek was actually launched last year, but it fully broke into Wall Street and Silicon Valley's collective radar, the consciousness, about 2 weeks ago, after the Chinese quant hedge fund that created DeepSeek released a white paper explaining how it was made on January 20th. The collective angst about DeepSeek caused a huge, nasty tech sell-off. I mean, like, sell. That was just last Monday. It demolished the stock of NVIDIA, and the market still hasn't really recovered from this development. The still unanswered question that DeepSeek has forced investors to ask is whether or not developers of AI applications still need to spend huge amounts on infrastructure in order to get the best results. But so far, the tech titans have stood by their major capital spending forecasts, and they haven't been punished for it. Specifically, last week, both Microsoft and Meta formally reported and reiterated these big CapEx budgets. I mean, sure, Microsoft sold off its quarter, but that was really because of a soft revenue number and discouraging revenue forecast. Meta reiterated its CapEx budget, and the stock soared. They were reveling in it. But now Alphabet's announced its own large CapEx number for the year, one that's right in the same neighborhood as that of Meta and Microsoft. Boy, the market hated it. And that is the biggest takeaway from Alphabet's quarter. And we have to see if this is an exception or if it's the new normal. Maybe investors simply trust Meta and Microsoft to spend the money more wisely than these guys. Doesn't seem to be the case for me, though. Now, I don't think this should be considered bad news for all of tech. In fact, you could argue it's somewhat bullish for NVIDIA and other AI hardware makers, which sounds like they'll continue to get robust orders from the tech titans, although after ARM tonight, which wasn't that great, I'm sure people say, wait a second, maybe spending is cooling. I don't think it is. We'll find out more tomorrow. These huge companies certainly don't seem to be taking DeepSeek seriously, though. That said, if the market is becoming more skeptical about these types of massive AI investments and even punishing companies that commit to that type of spending, as it did with Alphabet today, then maybe the hyperscalers will start dialing back their hardware investments. That would be bad for a whole lot of companies. Now, the next big event here is Amazon's report, Thursday night. Now, they have not yet pulled out their, we don't know what their CapEx guidance is going to be for 2025. So we'll see what they say. And more importantly, we'll see how it's received. I doubt it can change overnight, but I do think that Alphabet has put the big time spenders on the defensive. So you know what you think. It's a way to think about this number when you see it tomorrow night. Bottom line, though, we've gone pretty quickly from a world where major investments in AI infrastructure are cheered, I mean, literally cheered by investors, to a less certain world where it seems that the investors don't like it and are starting to get skeptical about some of these big spending commitments. Now, that's a huge change, people. And if it continues this way, we might need to rethink our top picks in tech going forward. And you know how I feel about this. So let's watch Amazon on Thursday and go from there. Mad Money is back after the break. Today, Uber Technologies reported the stock just got completely slammed, finishing the day down 7.6%. That's a hideous move, especially because the rest of the market was up. But honestly, like I said at the top of the show, I actually thought the quarter was good. I mean, like really good. Now, here's a stock that after roaring for years started selling off last October based on worries about autonomous driving, specifically robo-taxis. Uber's all-time high was set on October 11th, one day after Tesla's big Cybercab event. That event was originally considered underwhelming, big on hype, short of details. So Uber's stock popped more than 10% the next day. But that was as high as it got. Less than a month later, President Trump won the election, and given all the support he got from Tesla's CEO Elon Musk during the campaign, investors started taking the company's Cybercab ambitions much more seriously. Look, I think that was the right call, but you know what? I vehemently disagree that it's bad for the whole rideshare industry. When Uber reported its previous results at the end of October, the stock did get hit, even though this was a beat and raise quarter. Investors nevertheless seized on an oh-so-slight miss for rideshare bookings, and the stock sold off. So I was looking forward to this morning's report from Uber because I wanted to see if the company could set things straight. Long story short, we got the solid numbers that we were looking for, but it didn't mean anything for the stock, which just got pulverized. I mean, like obliterated. What the heck happened here? Well, first, I want to reiterate that Uber gave us very strong overall numbers. Gross bookings grew 18% year over year, substantially higher than expected. Revenue was up 20%, also higher than expected. The cash flow results were excellent. Net cash provided by operating activities grew by 130%, way ahead of expectations. Free cash flow up 122%, also a huge beat. Other operating metrics like monthly active platform customers and total trips exceeded expectations, too. The worst thing you could say about the results is that the earnings for interest, taxes, depreciation, and amortization, that is a key profitability metric here. We're merely in line. Okay. Uber's two main businesses, mobility and delivery, meaning ride sharing and Uber Eats, both beat expectations for gross bookings. Uber's smallest segment, freight, did have a gross bookings miss, but it doesn't matter. Uber also provided some guidance for the first quarter of 2025, and I call their outlook for the current period in line with expectations, though perhaps a bit short of Wall Street's elevated top-line expectations. The company expects gross bookings to grow 17 to 21% year over year, which was below the consensus estimate at the midpoint. Importantly, though, Uber said it expects a huge 5.5% currency headwind. That's not their fault. Uber also expects adjusted EBITDA to grow by 30 to 37% year over year. That's in line with expectations. I think it's pretty super. Now, to be clear, there were some small issues with the quarter. I mentioned the freight gross bookings miss and the slightly lower than expected gross bookings guidance for the current quarter, even as the latter can be explained away because of those currency fluctuations I just mentioned. There was also some noise with the company's operating income result. Like I said, adjusted EBITDA is really the key measure of profitability for Uber. It's what they guide for, and it's what the analysts care about. But the company's operating income result of $770 million was meaningfully below the $1.19 billion number that Wall Street was looking for. And some pointed to that as a reason for the negative response to the quarter. But wait a second. So I'm not buying that. Uber's operating income only came up short thanks to a $462 million expense for legal, tax, regulatory reserve changes, and settlements. As a one-time item, it does check out as the reason for the disparity. Again, there was some hair in the quarter, but was it enough hair to justify the stock's 7.6% decline today? In a midday reaction note to the Uber quarter, Melius research analyst Connor Cunningham said the following, quote, "The issue facing Uber is the earnings beats revisions are less intense now, and the bear case around autonomous vehicles can't be disproven quickly." Basically, the magnitude of Uber's beats for key metrics like gross bookings and EBITDA are declining, and that big, scary, long-term threat of autonomous competition looms. I think that's exactly what's holding the stock back, but I'm just not convinced that the robotaxi competition is a serious problem for Uber right now or even in the near-term future. See, this morning I got to speak with Uber CEO Dara Khosrowshahi on Squawk on the Street. He was right there with me, and there was a lengthy discussion about how the company's thinking about the autonomous vehicle threat. As he explained it, this is less of an existential threat to Uber, more of an opportunity. Putting aside all the obstacles to self-driving cars, once people are finally building them at scale, how are they supposed to make money as taxis? Well, keep in mind, Uber crushed all the old car services, so once these things exist, the people who buy them will want to partner with a rideshare app. When Khosrowshahi was asked if the introduction of Waymo into the San Francisco market has resulted in a meaningful market share loss, no, still too small to matter. In fact, Uber's rideshare business accelerated in San Francisco in the fourth quarter. More importantly, Uber and Waymo are going to be partners in some new markets like Austin and Atlanta. And by the way, Uber's been partners with Waymo for a while in Phoenix, enabling tens of thousands of rides there. No reason they need to compete against self-driving cars. Now, there was something else that the man universally known as Dara said during the interview that I think is important. A couple times he emphasized Uber's excellent free cash flow results over the past few years, including the record $6.9 billion result for 2024, which was up 105% for the previous year. At the end of the interview, when I expressed some dismay about the fact that the stock was down, Dara said, quote, "You know, while the stock is cheap, we get to buy it back, and that is not a bad thing." He's right. Around this time last year, Uber announced its first buybacks, a massive $7 billion authorization. And we knew from this morning's report that they only ended up spending $1.25 billion of that last year through the last month. Uber also announced that it completed a $1.5 billion accelerated buyback. But some quick math tells you that the company has plenty of money left on that program. And it sure sounds like Uber's ready to put that cash to work. I like that. So here's the bottom line. Today's quarter was not the clearing event that I had hoped it would be for Uber, but I'm still not ready to give up on this terrific stock. I think Wall Street's way too worked up about the threat of self-driving, which might not even be a threat at all. And this stock's worth buying into the weakness. Eric in Michigan. Eric.
Jim, I love the show. I'm a long-time listener, and I'm a club member. So there.
Thank you, Eric. Thank you very much. Thank you. How can I help you?
I'm calling on General Motors today. I'm a longtime shareholder. I love the company. I love the products. I know about the tariffs, and I love the share buyback. What do I do with this stock right now?
You own the stock, and Mary Barra is better than the 4 times earnings PE that you're getting there. I think that's reflecting every bit of the bad and not a lot of the good. Keep in mind, Ford disappointed again tonight. That could move GM stock down. I would be a buyer. Nicholas in California. Nicholas.
What's up, Jim? This is Nicholas live from East Palo Alto, California. First off, I want to say thank you for initiating the buy in Goldman Sachs. And my question today is about CrowdStrike. I recently trimmed half my position in Palo Alto Networks, been in it for a couple years, and used that profit to get into CrowdStrike. But I'm wondering, because Palo Alto Networks has been in the doghouse for a little bit now.
Palo Alto's going to be fine. Yeah, there's 3 analysts who downgraded. Now, Nikesh Arora, believe me, he's a CEO. He will, I'm telling you, he's going to confound those analysts. There's no way that guy is going to take sitting down the 3 different guys took it to a sell. That's straight. How about this CrowdStrike? I mean, it burst out today. It's now past where it was when they had that outage. And I say George Kurtz is the real deal. I want to go all the way down to James in Texas. James.
Hey, Cramer. Big hello from Texas, man. Hey, all the guys at #GreenRoom love your show. Got a question regarding SoundHound. Is it a meme
Yes.
stock or is it something more? And also,
I was talking about this.
think
I was talking about this with Jeff Marks today. It's very funny you mentioned that because SoundHound is a stock that my friend Dan Ives likes, and I don't like to go against Dan. I think he's terrific, but I think the stock is a little elevated. How about that, Dan? Don't get mad at me. You know I love your pink and your green jackets, although I wear Brioni. All right, look, I'm not ready to give up on Uber. I think, if anything, it's worth buying into weakness here. Now, much more Mad Money ahead. I'm hearing how the latest tariff headlines could affect apparel and footwear stock Calm, COLM, also known as Columbia Sportswear, after yesterday's earnings. Then I'm laying out a packaged goods playbook that you're really going to like. PepsiCo, Clorox, they've been going lower. What the heck's going on? All your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. Okay, what do we make of these numbers from Columbia Sportswear, the outdoor apparel and footwear company that you know as Columbia, Sorel, Prana, and Mountain Hardwear brands? Now, last night, these guys reported a seemingly mixed quarter with slightly higher than expected sales, but a 9-cent earnings miss off a $1.89 basis. Full year forecast and their guidance for the current quarter also came in light, and that's why the stock got clobbered today, down almost 6%. However, Columbia looks like it's going to return to sales growth this year. So if they deliver, this could be a turnaround story. It's the stock that just got quite a bit cheaper. It's got a fantastic fortress balance sheet. Let's take a closer look with Tim Boyle. He's the chairman, president, and CEO of Columbia Sportswear. Get a better read on the quarter and what comes next. Mr. Boyle, welcome back to Mad Money.
Thanks, Jim. It's great to be here with you.
Oh, thank you, Tim. Now, I'm going to just quote from what you said about yourself, because I think it's important because you're a man of great integrity. You said, while we made progress in many areas, our 2024 financial performance was short of my personal growth and profitability goals. Can you tell us what would have been something that would have made you happy and not feel like this?
Well, you know, frankly, for me, we've historically been in the high teens, both in the growth area and in operating margins. And frankly, when we're below that, my personal goals are not met. So we have to be a little bit more circumspect about, the fact that at those lofty times, we were a smaller company. It's a bigger time now. But frankly, when we're not operating at a high level in the upper quartile of our competitors, that's a problem for me, especially when you think about the company's balance sheet. You know, it's an embarrassment to me to be talking about an anemic growth pattern when we've got, over $800 million in cash, and we should be doing better. So if we think about historically when we've underperformed in an area, let's call China and Europe underperforming areas from a historical perspective, and we've worked diligently on those areas. We've seen growth, and frankly, we need to be putting the same sort of rigor around our North America business, which at the end of the day is the one remaining geography where we aren't performing as high as we need to. And so we've bundled a number of issues and strategies together in what we call Accelerate. And we're just going to be spending an incredible amount of time and effort on our North American business to get us back to growth.
Well, Tim, what gives me hope here is that I'm a big retail guy, and my parents were in retail, and all I ever think about with drumming in my head was inventory. Inventory is the bane of your existence, excess inventory. It looks like to me that is not your problem.
No, we've been working diligently to work our inventories down, which got bloated during COVID. And frankly, we spent arguably too much time because we concentrated on profitably liquidating those inventories, which had a dampening effect on the whole business. But we were able to successfully move the inventories down. We again had a down quarter in terms of our inventory perspective in Q4. And we think we can operate the business even with less inventories than we ended with at the end of the year. It's going to require diligence, and we're capable of doing that, fully capable, but which has to be a focus, and that's where we're going to be spending our time and effort, accelerating the business and lowering the inventories.
Right. Now, you mentioned brick and mortar, but you also mentioned that you had these, I guess, almost like pop-up stores. I'm not sure to get rid of the inventory, but brick and mortar in high-traffic areas. What is a high-traffic area for Columbia Sportswear?
Well, I would say in some of the best malls in the United States and in Canada, where there's very high traffic, where we can have 8 or 9 million people in a particular mall, and we get great positioning, and that's going to be part and parcel really of our marketing efforts, because we expect that those kinds of traffic figures will allow us to show off some of our technologies, which are complex and require an explanation, and also our footwear business, which we believe we had very high quality footwear and great products with great technologies, but it's tough to get adopted in the kind of way we would like it at our wholesale partners.
Well,
we're going to.
Well, it's interesting you say that. I've got your footwear, and it's very warm on really, really cold days, but doesn't look like they're not cloddy. But I had to learn about it. I mean, you can't. I had to learn about it because of the show. I wouldn't just buy it without learning about it. That's kind of a problem.
I agree. In fact, you're not the only one who's been critical of our efforts in marketing. So that's part and parcel of what we will do. We'll have these stores, which will have a minimal impact on the population. Where we're going to be spending more time and, frankly, more money will be in our .com business and marketing efforts, as well as talking about with TV ads and a larger, more mass media budget.
Oh,
so
terrific.
We're going to be putting, it's going to be important, and we need to be thinking bigger about how we talk about our products.
I totally agree. Now, you are a bit of an anomaly. Your business in China is very strong, and your business in North America isn't that strong. Plus, you're one of the most outspoken people about tariffs, where you recognize that tariffs are not a way necessarily to do business. Now, since you straddle both countries, and since you're doing very well in China, again, an anomaly, why don't you give us a view of why, one, that you're doing well there, and two, about how it doesn't help if you tariff them?
Well, as you know, tariffs are designed to raise the price of imported products. And so Colombia is one of the largest duty payers in the United States. And the reason that's true is that we are in a commodity, footwear and apparel, that's very highly tariffed already. Call it in the mid-teens area in terms of import duties, but some of our products carry 37.5% duty, so they're very high. It's a dampening effect, but more importantly, we need some surety about what is going to happen. What's the future? We import very little into the U.S. from China. China is an important part of our business, where we produce products in China for distribution in China and distribution in other parts of the world. But we have to be incredibly cautious, in my opinion, about how we go forward, because we don't know where these tariffs are going to appear and frankly, how much they're going to be.
And it doesn't seem like that it's going to bring back the seamstress business, the textile business. Those are long gone. We're not going to restart, right, Tim?
No, in fact, it's interesting. When we have a factory in Asia, forget the particular jurisdiction, but if we have a factory in Asia making either footwear or apparel, and an electronics factory opens up next door, everybody rushes away from the textile products into the digital environment. It's just a more highly sought after environment. So, yeah, it's a challenge, and it's one that we're frankly very good at navigating, but we need some surety about what's going to happen so we can plan.
Well, I sure wish people would talk to you, because they would understand better than anyone, because you actually have lived it and breathed it. I want to thank Tim Boyle, Chairman, President, CEO of Columbia Sportswear. You heard that the inventories are down. You heard they're going to do campaigns. The stock is down a lot, a fortress balance sheet. I think this stock is very interesting here. Thank you so much, Tim.
Thanks, Jim. Great talking to you.
Mad Money's back after the break. It is time. It's time for the light round. Case about Rapper calls when they're stated buy, sell, so particular no close stock. My Stanford is playing this way. And then the lightning round is over. Are you ready, Ski Daddy? Time for the light round. Case I'm going to start with Ben in Florida. Ben.
Mr. Cramer, you got your spikes packed in case Kellen Moore calls you in?
Yes, absolutely. Absolutely. Thank you.
And by the way, happy early birthday, buddy. Listen.
Thank you.
Yeah,
wow. Thank you. What's up?
I just try to invest. I don't trade, really. I'm betting on my kids' inheritance. And so I'm coming to my sensei for some advice. I have a moderate position in stock that recently beat earnings, revenues, EPS was in line, looking good in 25, about 11-50% versus prior year, stuff like that. Unfortunately, it's in a dicey spot in the evolving D.C. policies.
Okay.
But I think that cart needs a wingman, so I'm flying with BAH. What do you think?
I think that there are a lot of people fleeing this stock because of Doge, and I think that they think that this is somehow going to be front and center of the problem. I don't think that's the case. I think it's going to be the big military contractors that they're really going to go after. I'm with you on this one. Let's go to Ty in Arizona. Ty.
Professor Cramer, how are you?
I am. Professor's fine. How about you?
Doing good. I'm at the Waste Management Phoenix Open. I wanted to give a big booyah birthday shout out to my beautiful girlfriend, Amara. I love you very much.
Good for you, and that is some tourney that you're out there with. I know we got to get there one day. We have to.
It's beautiful. Right. You got to come out, Cramer. We'd love to have you.
Thank you.
Last week, you spoke about two companies I really like, Marvell and RH, insider buying.
Yes.
Recently, I noticed some insider buying on a stock that I like. I want to get your opinion. Stock ticker symbol MANH.
That stock got clubbed. I mean, they really crushed it. If there's insider buying in that, we're going to do some homework and find out because, wow, I cannot believe how much that thing went down. Ugly. Let's go to Trey in Minnesota. Trey.
Hey, Jim. Thanks for taking my call, and best of luck to your Eagles this Sunday.
Thank you very much.
So you put this name on my radar a few weeks ago, and then later that day in Davos, Trump had mentioned the need for coal to power AI data centers in our country.
Right.
With the new China tariffs on coal, this company operates 100% in the U.S. The stock has a 10% dividend yield. The stock I'm asking about is ARLP.
It's intriguing to me because I think the president doesn't believe in traditional global warming. If that's the case, then he must really like coal. I'm not a big fan of coal, but that has to do more because I believe in the science. But therefore, I think if I'm not in charge, he is. I would buy the stock. Let's go to Kyle in Wisconsin. Kyle.
Booyah, Jim. I'm a Jets fan since birth, but I'm flying right beside you in the Eagles so you can beat those teams.
I appreciate that. You're a very good man. I appreciate that. Thank you. What's up?
Well, Jim, I'm a huge fan of the show, a viewer since I was 12, and a first-time caller.
All right,
Jim,
good to have you
on. Jim, my stock's up over 130% over the past year, but it's reeled back in recent months. Cramer, is it the house of pleasure or the house of pain for Bitgear Technologies?
I'm going to do this because I'm a huge believer in Bitcoin, okay? I think you should just buy Bitcoin. That's what you want to do. We don't fool around. We buy the best. We leave the raggedy others to the rest. Let's go to Alan in Virginia. Alan.
Oh, yeah, Professor Cramer.
Thank you for the tenure. What's going on?
I'm a very satisfied investment club member. I've just renewed my membership for a second year. I want to thank you and your team for everything you do to help
Thank
us
you. We got a good
investors.
team. We're trying to teach. We're all small investors. How do I help?
My question is twofold about the same stock. What's your medium or long-term prognosis? And can you please explain whether interest rates affect this stock? The stock is SoFi Technology.
Okay, the reason why SoFi has moved from where it was to where it is because it is much more of a service provider stock. It's fintech than it is a lender these days. But I do think it needs to digest. I would not buy it at this level. Maybe put a quarter of your position on. Let it come in. It's been perched here precariously for a while. I think it can go down from here. Let's go to Nick in Maryland. Nick.
Yeah, what's up, Jim? Big fan. Calling in from Maryland.
Good.
Turf, #MVC. I grew up watching the show with my dad, and all I got to say is keep doing you, man. You're truly the GOAT.
Thank you.
Stock I'm calling about is Redwire, RDW.
Well, okay, so Redwire is part of a company. It does space work. And Professor Ben Stoto, who works with me, we both are kind of skeptical of space stuff. And I think we just have to kind of hold off. That said, we've done some work on this, and I'm not going to say that we're thrilled. I'm looking over at the professor right now. It's not necessarily one of our favorite stocks, Redwire. I think that we're going to have to hold off. And that, ladies and gentlemen, is the conclusion of the Lightning Round. The recent decline in the consumer packaged goods stocks, I find it breathtaking. The other day, PepsiCo got crushed in weaker than expected earnings. Clorox got walloped after a quarter that was not up to snuff. Mondelez reported a quarter that verified why the stock's been falling. Though after a lower opening and dip, buyers did come in. The stock ended the day higher. That was more about the bond market, I think. Kimberly-Clark gave you a pretty darn good report last week, but people still weren't happy. It goes on and on. Why is this happening? The truth is, there are a host of reasons, and every time you think that things have gotten better, they seem to have gotten worse, much worse than you've imagined. So take PepsiCo. I don't know if people realize how excellent this company really is. The stock always carried a premium priced earnings multiple, meaning we're willing to pay extra for its profits. They have terrific brands at Pepsi, at Mountain Dew, at Frito-Lay, the latter being one of the most dependable of all staples. But now PepsiCo's got a problem because Frito-Lay is not delivering the consistent numbers that it used to. Why? Management says it's because younger generations fixated on health, and there's nothing particularly healthy about potato chips or Cheetos. They'll buy smaller portions. That's what their hope is. Look, I'm sure that that's a part of it. But I do think that PepsiCo is in somewhat of denial about the impact of GLP-1 weight loss drugs from Novo Nordisk, which reported a terrific quarter this morning, and Eli Lilly, which reports tomorrow. I know the threat is real because these drugs eliminate your cravings for junk food, and they could ultimately be taken by 40 million people in this country alone, although that might actually be a lowball number considering that 42% of Americans, the adults, are obese. For Mondelez, the problem isn't just the GLP-1 softening demand for its candies and its biscuits. There's also the cost element. The price of a key ingredient, cocoa, is incredibly high right now. Most people thought that would be temporary, but it's held an astronomical level versus where it used to trade. Cocoa is now about 4 times the price that Mondelez has had to pay historically. That's devastating to their margins. Plus, they can't get away with the endless raising of prices like they used to. Oh, and let's not forget about the problem with tariffs. You're getting some sudden price increases for many goods. Someone has to pay for the tariffs. These companies hope it will be you. Because if it's not you, it's them. Third problem, if you're in the consumer packaged goods business, you have a hard time raising prices because when it goes up too much, you're going to get bushwhacked by an Amazon or a Costco, both of which offer really terrific private label products that many shoppers know that are as good as the originals. We buy Costco Kirkland brand toilet paper. We're comfortable with Amazon trash bags. We know from the former Costco CFO, Richard Galanti, that if these companies charge too much, it's easy to bring them down simply by creating a homegrown competition, the excellent Kirkland brand. Walmart has private brands under this great value name that compete in the paper goods, pantry staples, and cleaning supplies, as I like the stuff. Hey, you go to Chewy for cat litter, and you find Fresh Step, that's the Clorox brand. Then you see Frisco, the Chewy brand. And if the Clorox stuff gets too expensive, well, you might just easily go to Frisco. How much are you really going to pay up for kitty litter? Now, I know that private label's not growing all that much right now, but it's a force that keeps all prices down, including the branded ones. There were so many price increases put through during the era of COVID that the consumer is now desperate for value. And there's a reason why Walmart and Costco keep hitting new highs. They put a ceiling on so many products, both by forcing their suppliers to keep prices down or by blitzing them with house brands that seem just as good at a lower price. I don't know what turns around the consumer packaged goods stocks. Mergers would make sense. This new antitrust department probably blessed the concentration. Maybe the companies that slash prices the deepest ultimately win? No matter. This moment is untenable. The stocks can't find their footing, just too many forces against them. These used to be safety stocks, for heaven's sake. But they are safe no more. I'd like to say there's always a bull market somewhere. I promise I've got it just for you right here at Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.